Mark, I'll start with you. Give me your reaction to what you just heard, of course, moving up the move to so-called profitability. They still lose an awful lot of money right now.
Yeah, they do lose a lot of money. When this company went public, it was the biggest loss-generating IPO ever. So the number one issue for investors, for the street, for the market was prove the path to profitability. If they do that, the stock goes higher. And that's what they've done the last couple of quarters. Especially what investors should focus on is that core rides business. It's doing 24% EBITDA margins. They think they can get to 45% EBITDA margins, and they're telling you that a quarter of their market is already there. That means there's a huge profit pool just off of the rides business. You don't have to believe in ATG. You don't have to believe in Eats. You can buy Uber and make money just on the rides business today. That's why we like it. It's our number one pick.
Wow. All right. Explain to me the 45% EBITDA margin. How do they get there? Is it raising prices? What exactly is it in terms of they're taking costs out? Help me understand that number.
Yeah. I mean, look, David, it's the key question on the stock. And so the one key data point is they're already there in about a quarter of their markets. So it's not like it's not all on the come. It's already there in some of their markets, some of their largest markets, too. And then secondly, they're going to get leverage against things like insurance costs. Third is that I think they do have pricing power. The value proposition of Uber and Lyft as a ride-sharing business, it's much broader than just it saves me money as a user. We've done extensive survey work on this. It's practical. It's better than public transportation often, not always, but often. It's better than the taxi experience almost always. So I just think that they do have pricing power. They can get leverage against some of their core expenses, G&A, R&D, et cetera. And that's where you're going to see this ramp to profitability. I don't know if they get to 45%, but the path to 30, 35, 40%, I think is very clear.
Do you agree, Jason? I think you like the stock as well. See it going to 50.
We do agree. I mean, this morning we took up our EBITDA estimate for 2021 by almost $1 billion. We agree with the sum of the parts logic. And we think kind of where investors were penalizing the stock was there was a focus on regulatory issues, London, Los Angeles, and they were kind of hesitant, even if they believed in that kind of 2021 EBITDA number, they were hesitant to put, we'll call it a growth multiple on that. And what you're seeing kind of over the last month and kind of through today is investors, A, are getting more comfortable with it as a growth story, and estimates went up.
Hey, Mark, got to give you credit. You named Uber as one of your top picks going into the new year. I wonder, though, at this point, does the street still wish the model was as thematically pure as Lyft's?
That's a great look. The debate we oftentimes have on this stock is, what should I own? Like, Lyft is the cleaner story. I don't have to worry about an Eats business. It's just in the U.S. market. I get that. For a short-term perspective, those points are very valid. Longer term, you want the company with greater market share. That's Uber. You want the company with international exposure. I don't know of a mega cap internet tech name that doesn't have large global presence. So that's Uber's advantage, too. And then I think they'll be able to figure out ways to get Eats to profitability. Look, they're either going to cut it to profitability, i.e. sell Uber Eats in India and in South Korea, or they're going to scale it. Another great data point from last night was they're in 25-plus countries where they're the number one or number two player in the Eats category, in the food delivery category. Dara so far has been good to his word. He says, if we're not number one or number two, we're out. He's done it twice. I've got a long-standing relationship with Dara. I've watched him over the years. This guy executes well. It's one of the reasons why that stock is part of our FANG-U portfolio.
On Eats, I mean, didn't the EBITDA loss also reach a new high?
Yes. Yes, it did. So the key thing for investors now is when it is a problem. When are we going to get peak Eats losses, EBITDA losses? I think we're going to get that in this March quarter, March or maybe the June quarter. That's going to be kind of the next catalyst. So we don't have it yet. I'm just saying it's a pending catalyst when that Eats loss starts to decline.
Yeah, Jason, back to you. I mean, the California change in the employment status of their drivers. Right now, they're not operating in London. Unclear whether they're going to be at any time soon. There continue to be some challenges, aren't there?
Yeah, so look, I think what people are recognizing in that in every country, and in some cases in certain markets per country, there will be a regulatory framework. And ultimately, what Uber's advantage should be, if you are the largest company in the ride-hailing space, you have the resources to work through the regulatory regime in each market. Specifically on LA, we actually asked Darren on the call last night. Ironically, he said it's actually working out better for drivers because they're getting paid more under their kind of adjusted model. Riders, unfortunately, are paying more. Unclear how that's impacting demand in California. But, I mean, they're doing this so they can say, look, we are not, AB5 compliant. And then the question would be, would you have to kind of deploy that in other markets? But it sounds like LA, they're managing so far so good. And, also they were optimistic on London last night on the call.
And Mark, you're so bullish that you're actually trying to make Fangu a thing. You're adding it to Fang.
Yeah. Yeah, Fangu. Look, it's a large category. It's a market leader.
Not Fangu.
I think a pretty good management.
Got it.
Yeah, Fangu very much. No, I think I think it's a large enough market opportunity, good business model. You put those things together. It's still early. I know it's still speculative. There are a lot of risks. There are regulatory risks here. There are execution risks here. But I'm intrigued by a company of that scale growing at that size with that kind of profit potential. Yes, it could be as good as Fang. So Fangu.